Double candlestick patterns. Now we have already learned about single candlestick patterns and how to trade using those single candlestick patterns. Now let's go one step ahead and understand about different types of double candlestick patterns. But first and foremost, what is a double candlestick pattern? So, a double candlestick pattern is formed by appearance of two sequential candles on a chart. Now together these two candles would indicate a profitable and tradable pattern, but make sure that you backtest this particular pattern first. The logic and idea behind this two candlestick pattern is that the first candlestick, known as the signal candle, it will give an indication where the market currently stands, while the other candle, what we call it as the confirmation candle, will either support that direction or it can tell you about an incoming trend reversal. These patterns can be used as standalone patterns, or you can also combine them with other indicators such as volume, volatility, and general market sentiment, rather than using them in isolation. Now, remember, effectiveness of these double candlestick patterns would also depend on traders' proficiency in identifying these patterns correctly, how effectively you perform risk management, and how effectively you combine these candlestick patterns with other technical indicators. This will all help, or this will all define the effectiveness of double candlestick pattern. Now there are going to be a bunch of double candlestick patterns that we are going to learn about. Let's have a look at all of them one by one. Engulfing candlestick patterns. The engulfing pattern needs two trading sessions to evolve. In a typical engulfing pattern, you will find a small candle on day 1 and a relatively long candle on day 2, which appears as if it engulfs the candle on day 1. If the engulfing pattern appears at the bottom of the trend, it is called the bullish engulfing pattern, and if the engulfing pattern appears at the top end of the trend, it is called the bearish engulfing pattern. Let's have a look at bullish engulfing. The bullish engulfing candlestick pattern indicates bullish reversal, which shows a rise in buying pressure. This pattern indicates a reversal from downtrend as more buyers enter the market and move the prices up after a long downtrend. So this is what it will look like, where there's an ongoing downtrend, then there's a green candle that completely covers the body of red candle. This is what we call as engulfing, and this indicates a reversal, or the downtrend now gets converted into an uptrend. So the pattern, it consists of two candles where the second green candle, it completely covers or engulfs the body of previously created red candle. Now we should always remember that whenever we are trading with bullish engulfing pattern, the previous trend should be a downtrend. And additionally, we should always use additional signals. That is, I will confirm the reversal signals given by this pattern with other technical indicators. Next one is our bearish engulfing pattern. The bearish engulfing pattern is the opposite of the bullish pattern. So it signals a reversal of the uptrend and indicates a fall in the prices by the sellers who exert the selling pressure when it appears at the top of an uptrend. So this pattern, it triggers a reversal of ongoing trend as more sellers enter the market and they make the prices fall. So as you can see in the picture, there's an ongoing uptrend, but then there is a formation of this big red candle that completely engulfs the green candle, indicating beginning of a downtrend or reversal of uptrend into a downtrend. Now, how do engulfing patterns work? First, they act as trend continuation. That is, engulfing pattern, they support the continuation of the ongoing trend. Meaning, if we spot a bullish engulfing pattern in an uptrend, it indicates the ongoing trend will continue. They act as reversals. That is, bullish and bearish engulfing patterns, they always signal reversal in the trend. When a bullish engulfing pattern is found at the bottom of downtrend, it signals uptrend reversal, and when a bearish engulfing pattern is found at the top of an uptrend, it signals a downtrend reversal. Last but not the least is your exit strategy. That is, we can use engulfing patterns as a signal to exit if we are holding a buying or selling position in the ongoing trend that is going to come to an end. So here's a table that summarizes how engulfing pattern they work, what are their characteristics, and what signals they indicate. Now, what are the key takeaways on bearish and bullish engulfing pattern? The bullish and bearish engulfing patterns, they involve two candles where the second candle would completely cover or engulf the body of the candle formed on the previous day. The engulfing candlestick can be bullish or bearish based on where it forms with the ongoing trend. The bullish engulfing candle, it signals a reversal of a downtrend and indicates a rise in buying pressure when it appears at the bottom of a downtrend. And similarly, the bearish engulfing signals reversal of the uptrend and indicates fall in prices by the sellers who exert the selling pressure when it appears at the top of an uptrend. Last, engulfing candles, they help the traders in spotting the trend reversals. They also indicate trend continuation, and traders can plan their exit accordingly using these engulfing patterns.
Piercing line pattern. A piercing pattern is a candlestick pattern that gives us potential bullish reversal sign, and it is formed near the support levels at the end of a downtrend. Piercing pattern is formed when the bulls and bears both are fighting to gain control over the prices. This pattern is made of two candlesticks. The first one is a bearish candlestick and the second one is a bullish candlestick. The bearish candlestick should have a large real body, and the open of second bullish candle should be below the low of previous candlestick and should close above the middle of the real body of the first candlestick. There is an increase in demand by the bulls and the price it starts rising, and hence you can see an uptrend. Firstly, the trend should be a downtrend as the piercing pattern is a bullish reversal pattern. Secondly, the length of the candlestick plays an important role in determining the force with which the reversal will take place. The gap down between the bearish and bullish candlestick indicates how powerful the trend reversal will be. Next, the bullish candlestick should close more than the midpoint of the previous bearish candlestick. And lastly, the bearish as well as bullish candlestick should have large real bodies. Now, how do I trade with piercing line pattern? We can plan our entry after we get confirmation that the stock is in uptrend. So your entry point would be somewhere at the close of day 2 candle. So you can take your position over here once you start seeing green candle getting formed, and the stop loss can be placed at the open price of the green candle in your piercing line pattern. So in case if the market does not go in your predicted direction, then you can exit your position. So that's about piercing line pattern and trading with piercing line pattern.
Tweezer tops and bottoms. Tweezer patterns are two candlestick reversal patterns. This type of candlestick pattern is usually spotted after an extended uptrend or downtrend, indicating that a reversal will soon occur. There are two types of tweezer patterns, the tweezer top and tweezer bottom. First, tweezer top. The first candlestick is the same as the overall trend. That is, if the price is moving upwards and we see all green candles, then the first candle would be a green candle. The second candlestick is opposite of the overall trend, meaning the previous trend was bullish, all green candles were getting formed, hence the second candle will be red in color. The shadows of the candlesticks should be of equal or approximately equal lengths. The tweezer tops should have the same highs. That is, both these shadows should be of the same length. Now next, tweezer bottom. The first candlestick is same as the overall trend. That is, if the price is moving downwards, then the first candlestick should be of the same color, meaning previous candles are red, then the first candle would also be red in color. The second candlestick would be opposite in color, that is, the previous candles are red in color, so the second candle would be a bullish candle or a green colored candle. The shadows of again these two candles should be of the same length, that is, here I can say that the tweezer bottoms should have the same lows or approximately the same lows. Now, importance of this pattern. When traders see formation of tweezer top and tweezer bottom, here we should understand that the market trend is now going to change, meaning if there is a ongoing uptrend, it could potentially reverse and we could now see a downtrend and vice versa. We should square off our position when we see this incoming candlestick pattern. We should also confirm the formation of tweezer candlestick pattern with other technical indicators. So, what I can conclude? Tweezer top and tweezer bottom is a trend reversal pattern that involves two candlesticks. Tweezer top candlestick indicates a bearish reversal, whereas tweezer bottom it indicates a bullish reversal. When traders see formation of tweezer candlestick pattern, then we should understand that there is a potential incoming reversal and we should confirm this incoming reversal or the formation of this tweezer candlestick pattern with help of other technical indicators. Dark cloud cover. The dark cloud cover candlestick pattern is a reversal candlestick pattern. It is formed at resistance during an uptrend. The dark cloud cover candlestick pattern is a double candlestick pattern that consists of two candles. The first candle is a large bullish candle and the second is a bearish candle. Color is important in this double candlestick pattern. The first candle should be green, followed by a gap up the next day, and the second candle will be formed red. The close of this bearish candle is below the midpoint of the previous day candle. The dark cloud cover candlestick pattern gives signals for downtrend. If this candlestick pattern is seen forming on the chart, then along with it, we also have to look at the volume of our second candle. If its volume is high, then the chances of market reversal are high. And also, if the volume of subsequent candles that are formed after this second candle, they also have a higher volume, then there is a greater possibility of the market going into downtrend. In this double candlestick pattern, the more gap up the second candle opens to form bearish candles, the stronger and more powerful the reversal in the market. Upon confirmation, you can mark your entry at the point that crosses 50% of day 1 and stop loss at opening of day 2 candle. The only difference between piercing candlestick pattern and dark cloud cover candlestick pattern is that piercing candlestick pattern is formed on support, which gives a bullish signal, and dark candlestick pattern shows us formation on resistance and gives bearish signals. When this candlestick pattern is formed, its signal should be confirmed with technical analysis such as using indicators like trend line, support, resistance, etc. We should confirm its signal by looking at all these. Harami candlestick pattern. The word harami, that means pregnant in Japanese, is a multiple candlestick pattern. It is considered a reversal pattern. Harami is a 2-candle pattern. The first candle is usually long and the second candle has a small body. The second candle is generally opposite in color to the first one. The first candlestick is referred to as the mother, with a large real body that engulfs or embodies the smaller second candlestick, and thus creating a visual of a pregnant mother. Harami candlestick pattern is the opposite of engulfing pattern, except that the candlesticks in the harami can be of the same color. On the appearance of harami pattern, a trend reversal is possible. Now again, we have two types of harami patterns. One is the bullish harami and the second one is the bearish harami. Let's have a look at bullish harami candlestick pattern. Bullish harami is a bullish pattern appearing at the bottom of the chart or at the end of a downtrend. The bullish harami pattern evolves over a 2-day period similar to the engulfing pattern. A bullish harami candlestick is formed when a large bearish red candle appears on day 1 and it is followed by a smaller bullish candle on the next day. One should note that the important aspect of the bullish harami is that the prices should gap up on the second day. Now, how do I trade using bullish harami pattern? The idea is to go long on the bullish harami formation. Aggressive traders can initiate a long trade around the close of the second candle. Additionally, aggressive traders should validate a couple of conditions before entering a trade using this candlestick pattern. First one, the opening of second candle should be higher than the close of first. The current market price of second candle during previous day's close should be less than the first candle's opening price. If both these conditions are satisfied, we can conclude that chart shows a bullish harami pattern. Safe traders can initiate a long trade at the close of the day after second candle completely forms. In other words, safe traders can enter only after confirming that the second day is forming a green candle. Now, if I have to talk about the stop loss, then the lower wick of these two candles whichever is on the lower side will be my stop loss for a particular trade. Next is the bearish harami. The bearish harami pattern appears at the top end of an uptrend, allowing trader to initiate a short selling trade. A bearish harami candlestick is formed when there is a large bullish candle on day 1 and it is followed by a smaller bearish candle on day 2. One should note that the important aspect of the bearish harami candlestick is that the prices they gapped down on second day and they were unable to move higher back to the close of day 1. Now trading with bearish harami pattern. How do I trade using this particular candlestick pattern? So the idea would be to short sell. That is, if I am an aggressive trader, I can initiate or I can short the market near the close of second candle after ensuring that a bearish harami is being formed. Now again, we have to validate few conditions to ensure that the pattern is indeed a bearish harami pattern. First one, the open price of second candle should be lower than the close price of first in bearish harami formation. The close price of second candle should be greater than the open price of first candle. Safe trader will short the market the day after the second candle after he has ensured that it is indeed forming a red candle. The highest high between these two candles will act as the stop loss for this particular trade. So that's all about bearish and bullish harami candlestick and trading with these two candlestick patterns.